Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Two notes of gratitude prior to starting today's podcast. Big thanks to Tracy from our office for having the foresight of approximately a year ago of buying us this awesome Investment Wars sign. Thank you. And then thank you for a longtime listener for actually suggesting a show on the LA fires. Today we have the privilege of having Jerry Theodorou as a guest to discuss the complexities of insurance with a focus on the LA fires. Jerry is the director of the Finance, Insurance, and Trade Policy Program at the R Street Institute, a public policy research organization. In this role, he develops and promotes free market public policy solutions to complex issues involving federal and state government interventions. Before joining R Street, Jerry was a director of insurance research at Conning, an insurance asset management and research firm in Hartford, Connecticut. Prior to that, he held various global underwriting operations and strategy roles at American International Group, AIG, for those who know it, including nearly a decade of expatriate managerial assignments in Europe and the Middle East. Thank you for coming on our show today, Jerry.
Thank you, Joe. It's a pleasure to be with you and Investment Wars.
Thank you. So we're going to discuss the LA fires, and let me just set the scene. I think, unfortunately, everybody knows about them. This past January, the LA area was ravaged by a series of devastating wildfires, notably the Palisades and Eaton Fires. Collectively, over 16,000 structures were destroyed, tens of thousands of evacuees, and 29 fatalities. Wildfires seem to be an annual event in California, destroying property and risking lives. I'd like to explore with you how the insurance industry has coped historically with catastrophes, the current state of insuring property in places with high risks to events like fire, hurricane, flooding, and the like, and some thoughts on the future of the insurance industry. Jerry, maybe a starting question is, how does the government play a role in insurance in the space?
Yeah, thanks for the question, Joe. When we talk about the government and its role in insurance, it's important to distinguish between the federal perspective and the state perspective. Insurance is regulated at the state level. Every state has a Department of Insurance, with a Commissioner of Insurance that work to advance policyholder interests, protect policyholders from insurance fraud, and making sure that insurance rates, are neither excessive nor inadequate nor unfairly discriminatory. And at the same time, the Commissioner of Insurance, the Department of Insurance, wants insurance companies to be solvent so they don't go out of business or leave the state. So that's the main regulatory role of insurance commissioners and insurance departments, protecting policyholder interests and also seeing to the solvency of the insurers. So it's a little bit of a balancing act about who you favor. On the federal level, there are some programs that are federal, that are national. There's the National Flood Insurance Program, which is an insurance program that insures flood losses, because flood losses are excluded from the ordinary homeowners insurance policies. There's also the federal crop insurance program, which is part of the Farm Bill. And there's a couple of little other programs for radiation workers, nuclear exposure, longshoremen, some niche workers' compensation. But really 95% of insurance regulation and intervention is at the state level. And if you look at the states and the different ways, the different regulations that are built into the statutes, there's differences. So when you've seen one state insurance regulatory department, you've seen just one. So it's a complex matrix.
Yeah, you understood. And I want to, one of the, regulations are always interesting, right? It's trying to protect the little person and hopefully make it better for society. I'm going to grab on one word you said, which is excess, to ensure, or ensure is probably a bad word, to make sure that the insurance for companies don't charge an excess fee. And I could see this bumping up in areas of California that maybe have, now I'm purposely using the word excess risk, of wildfires or catastrophe. So how does that play out? I can imagine, just as someone who's priced risk before, an insurance company may decide, I don't want to touch that. Could you speak to that a little bit?
Yeah, sure. Indeed, in the role of the insurance regulators in every state, there is the need to make sure that the rates are not excessive. So in most states, insurance companies that want to change their rates, whether to raise them or to lower them, typically will fill out a request. They create a filing for a rate change. They justify the the value of or the extent of the change with actuarial tables that show this would be the impact on this portfolio, this book of business, and insurance commissioners will approve or disapprove the rates. Sometimes an insurance company can file for a 10% rate increase, and the commissioner comes back and only grants a 5% rate increase. So there's back and forth like that. And insurance companies don't overprice risk on purpose because it'll jump back to bite them. If you price yourself out of the market, insurance is highly competitive. There's over 2,000 insurance companies in the United States.
Wow.
So if some company is raising its rates above and beyond what's necessary, what's justified by the actuarial uh, classifications, competition and free market forces will drive them out of the market. So that's the general picture. California, though, is special. California is different. In 1988, 37 years ago, there was a shareholder proposal called Proposition 103 that was passed. Just barely, just over 51% uh, said yes, we approve of this, and 49% did not. So it was passed very narrowly. And in those last 37 years, the application of the provisions of this Proposition 103 have really crippled the California market and have distorted it. So whereas California has got elevated risk, the average premium for California homeowners is actually lower than the national median, even though it's exposed to flood and to wildfire, to drought and all these natural earthquake, of course, earthquake. Um, so California is special. There's there was a postcard that I saw once in Southern California that says, "Welcome to California and its four seasons." It's four seasons: fire, mudslides, earthquakes, riots. All right, I said riots there, and it was actually the riots, the Watts riots, Watts, a section of Los Angeles in the 1960s, that caused enormous property damage, and that was the stimulus for creating an insurance pool, a government insurance pool, again regulated at the state level. So California has had this crippling legislation passed 37 years ago that in the main prevents insurers from getting the rates that are needed. And because there's not approval given for rate increases, a lot of companies have left the state. They say, well, we can't make money here. We'll put our capital to use in other states where we have a better chance of making a reasonable profit. And insurance companies only make reasonable profits. The median margin is about 6% compared to 14% for S&P 500 companies. So Proposition 103 has been the albatross around the neck of insurance companies that has caused many to leave the state, has made it difficult to get the rate increases, has allowed these interveners. Interveners are citizen groups that intervene in rate increases, and they argue against the insurance companies. Typically, they're very populist, especially in states where the commissioner is elected. There's 11 states where the insurance commissioner is elected. California is, of course, one of them. And this creates a very populist atmosphere and has the public believe that insurance companies are to be fought and to be opposed, whereas the result of this kind of scrutiny and dragging feet on approving rate increases can take over a year, and the interveners and having hearings. So all these provisions of Proposition 103, including the self-preservation provision, which is that in order to change anything in Proposition 103, you need two-thirds majority in both chambers of the California legislature. And these interveners, and there's one big one called Consumer Watchdog, has collected about $25 million in fees in the last 15 years or so. So it's sort of a
Where did they
conflict
collect
of
fees
interest.
from?
I'm sorry?
Where did they get, what does that mean they collected $25 million of fees? From where?
From insurance companies.
From insurance companies.
From
Okay.
insurance companies, yeah. So they
Wow.
they protest the uh, the rate increases, and then they conduct hearings, and they charge by the hour. Administrative law judges,
Okay.
and the insurance company's got to pick up the tab. Now, this is starting to change. About a year and a half ago, this was like the first time that the commissioner denied the rate increase, said, look, this is not a good filing. It's just copy and paste from a previous one. So things are starting to change because, as you have and as your viewers and followers know, California does have issues with insurance, with the availability and the affordability of insurance. So I turned the spotlight onto Proposition 103, which is which really is the devil in the works.
Thank you for that. So I want to unpack a few items here. So first of all, is homeowners insurance mandatory in California? You buy a home, do you have to have insurance on that home?
No, you don't. You can what they call go bare, which is not to have insurance. It's required if you have a mortgage that's issued by one of the government agencies, Fannie Mae, Freddie Mac, FHFA, the sort of government housing uh, bureaus require you to have a mortgage from a bank.
Yeah, I imagine, right. So I imagine most, even private mortgage providers would want, since they have some skin in the game, they'd want you to insure it, because otherwise it becomes very easy to walk away from a catastrophe. I mean, it's always conceptually hard, but the math is there. And there's a few items you threw out that I just want to understand a little better. So one, I think you mentioned there was a state fund, so there's an insurance fund. Two, you said the prices are lower generally in California, and that might be a relative term because then you also said that it's expensive for some homeowners to buy insurance. Um, could you kind of maybe speak to those? I don't want to go too fast here, so let's maybe talk about the costs because it sounds like California is kind of putting pressure and artificially keeping the prices low. But even with the prices low relative, and I'll say maybe it's relative to risk, the prices are still actually high in a lot of areas. Is that correct? Did I catch that right?
Well,
Or
I mean, if you look at the numbers, what does the data show? The median homeowner's premium in California is about $1,350, uh, just under $1,400. The median for the entire nation is about $1,500. So
okay,
California homes are exposed to more natural catastrophes, but the premium is lower. So that really suggests that something is wrong here. If there's more risk, there's going to be more losses, and you're going to need more premium from the insurance company perspective to cover that loss. So it's artificially depressed. Now, the issue that is coming to the fore recently is on the on availability. Insurance companies that say we're not going to cover this property, and if the insurance agent, if the homeowner is represented by an agent, can't find a market that's competitive, a price that's competitive, there is the insurer of last resort, uh,
okay,
FAIR plan, FAIR, fair access to insurance requirements. So most states have these bodies, the FAIR plans that are the insurers of last resort. And today's Thursday, the 2 days ago on Tuesday, it was announced by the insurance department that there's going to be an assessment. Now, this is very important because there hasn't been an assessment since 1994. Now, what is an assessment? Assessment is really passing around the hat. The FAIR Plan, the insurer of last resort, basically doesn't have enough money to pay for the losses that happened in Eaton and Palisades and the other fires. So it doesn't have enough money for that, and they projected that their money's going to run out by the end of March next month, paying these claims. So an assessment was approved, which means that every insurance company that's operating in California is required to contribute to this to the FAIR Plan to make it solvent again. Um, and So this assessment is going on again. So this illustrates the magnitude of these events. So the assessment was approved, and it's going to raise about $1 billion from insurance companies that are operating in California, except for special class of insurers that are called surplus lines insurers. And the value of the assessment is related to the market share. So if a company's got 10% market share, it's going to contribute $100 million, which is 10% of $1 billion. So this is the action of the FAIR Plan, which is now under the spotlight. And the FAIR Plan has been the repository for the highest risks. If an insurance agent can't get a decent quote from one of the private insurance companies, it's because the risk is very elevated. So what you have in the FAIR Plan is really a collection of high risks. And normally, when you have a really high risk, you need to charge more. And indeed, the premiums at the FAIR Plan are typically about double of what they are. But that's not enough really for the risk. I mean, I'm a homeowner. I'm in Connecticut. We don't have natural catastrophes here. It's a very boring state, and we like boring from a natural catastrophe perspective. And my premium is almost $2,500. I'm not in California. I don't have all that exposure. So this illustrates how the California market has been artificially distorted with this underpriced risk and creating difficulties for insurance companies to get the rate that they need. Rate follows risk. Insurance companies allocate their capital to risk, just as banks do and other companies that take on risk.
Right. So the FAIR Plan, the insurer of last resort, is that a composite of all the licensed insurance agency or firms in California, or is it partially government funded, or like where's that money coming from? Or
From insurance companies. From insurance companies. Yeah.
So it is okay, so they're all kind of, okay, I got you. And then, okay.
And again, it started when something very unexpected happened, the Watts riots of 1966 or so, which had phenomenal property destruction. And the insurance companies, well, how do we price for riots? We don't have a lot of data for that. So that's when the idea for the FAIR Plan was launched.
Understood. So stepping back I understand, it's, I think for average people, I'll include myself here because I'm not an insurance expert like you are. You get a bill, and you mentioned $2,500, and you're probably more equipped or very equipped to kind of say like, okay, that's very reasonable. You have a house. I'm just going to use round numbers. You have $1 million house. You pay $2,500. There's a deductible. If the house is destroyed, that insurance company has to pay out more than they've ever collected in premium on that house itself. And so catastrophic events are inherently incredibly risky for insurance companies because you're essentially paying out. You're losing on some properties. You're losing straight out, and that means you're winning from premiums you collect in other businesses. And you mentioned earlier in the call that on average the margins here are about 6%. So that's pretty tight, which means that people are really getting their money's worth for something that you hope you'll never have to use. I want to step back for a moment because I think there was a big event, or I know there was a big event, the 1992 Hurricane Andrew event in Florida, devastated Florida. I remember it. Over 25,000 homes were destroyed. Over 100,000 homes were damaged. It was at the moment the most expensive catastrophe in history. I think the LA fires obviously surpasses it. It's just a different world nowadays. My understanding is back then, 16 insurance companies went insolvent. I'm not sure who picked up the bill on those companies, meaning like if you were a homeowner with one of those insurance companies, were you covered federally? Were you covered somewhere else? And do we expect any kind of using that as an example? I want to understand what the industry learned. In other words, like, are there any companies that are going to go insolvent from these LA wildfires, as an example?
Well, yeah, indeed, Andrew, 1992 was a seminal event, and it did have those adverse consequences. 16 companies going out of business, not recognizing the potential magnitude of one of those big events. And since that time, the insurance industry has learned and implemented a bunch of lessons. First, 1992 gave birth to catastrophe modeling. Insurance companies started to look at their data more and to think about what could possibly happen, what's the worst that could possibly happen. And these sophisticated models were developed and they were enhanced over the years, incorporating new information. So now, just like with weather models, you can listen to your weatherman and he can tell you what the weather's going to be like in 3 days. Weather models have improved significantly. So it gave birth to the CAT modeling or catastrophe modeling industry, which now has gotten a lot more sophisticated and helps companies, insurance companies, to calibrate risk more carefully. And the 16 failures were people paid out. Yes, policyholders were paid out. There's another institution. There's another pool of capital, which is the Guarantee Association, the California Insurance Guarantee Association. For companies that go insolvent, the Guarantee Association takes on the responsibility of paying those claims. And again, it's by assessment. Just like the FAIR Plan, it's fed by the capital of insurance companies operating in the state. Now, here's something which is kind of good news. A couple of years ago, we had the Camp Fire. About 3 years ago, the Camp Fire was just about as destructive as what we're seeing today. And in the wake of the Camp Fire, there was only one insolvency. There's only one insolvency. The Merced Property Insurance Company, small carrier that had a concentration of risk close to where the campfire was burning. So 16 companies failed at 1992 Hurricane Andrew, and now just one failed from the campfire. And then going forward, it doesn't look as if there's any insurance company that's going to be insolvent and sending policyholders to the Guarantee Association to get paid. All of Merced's claims were paid. The the character of the California market is that unlike Florida, which has some Florida-specific companies that only concentrate on Florida risk, in California, 9 of the top 10 or the largest insurance companies operating in California are nationals. So they've got business all over the country, the familiar household names and the gecko and all these um, uh, advertising things that you see, uh, the big jumbo national insurance companies. So those companies can take it on the chin because they've got business all over the country. They have got diversification. And going back to how you started the question, Joe, a house that has total loss of $1 million, there's not enough premium in the world that a policyholder is going to pay for that unless they want to go bare and have $1 million escrowed. So the way that insurance works is that you create pools. You have a pool of capital so that the principle is that the premiums of the many pay for the losses of the few. So by diversifying the risk, you're not going to have that concentration that Merced had, that was heavily in the campfire area. And so the purpose of what insurance companies try to do is to create healthy pools. They've got large pools of capital, but they don't want to be like the FAIR Plan and only have risks that are very exposed to catastrophes. So that's story since 1992.
So okay, thank you. So I want to kind of go down that road a little bit more. It feels like the industry really matured, and we're big believers of diversification as well. So two kind of items you pointed out was one, we have way better modeling. We've had tons of innovation over the last 40 years. You have so much more technology where you're able to, you mentioned weather, but you're able to effectively monitor. A lot of times they could see these are the different paths that it may take, and just a better understanding of the risk. That's number one. Number two is increased diversification. So, kind of going back to that national average, I think you mentioned $1,500. Someone like Gecko, who do have great commercials and a great little gecko thing going on there, they are spreading their risk across the country. And so if they lose, let's say, $100 million properties, which is $100 million, they've already priced it in. And just to be clear, Jerry, earlier you mentioned a 6% margin. You know, that margin, that's taking into account this idea that you're going to have losses in your portfolio. It's not like this is a margin with nothing ever happening. So they're pricing in what they estimate the risks are. There's one other item, to my understanding, that plays a role in diversification that I think the audience would really appreciate. Jared, if you could speak a little bit to what, like, just define reinsurance and what role reinsurance has in the insurance industry, I think that'd be
Sure,
helpful.
thanks. Yeah, I'll tackle the first question first.
Yeah.
And the way that a large or even medium-sized company achieves diversification is twofold. One, you have product diversification. So I mentioned that the 9 of the top 10 insurers operating in California are these large nationals. There's one publicly traded company that is not a large national. It's got heavy concentration in California, but recognizing that having a portfolio filled with California homeowners insurance is not the best way to diversify. It's not diversifying, it's concentrating. They have other lines of business that should compensate for the losses. So, in addition to homeowners, there's automobile insurance. Customers, commercial customers have workers' compensation insurance, commercial general liability insurance, directors and officers liability, so that a well-diversified company from the standpoint of product diversification is not putting all its eggs in one basket. And the second form of diversification is geographic, not being totally exposed. About 15 years ago, there was a tornado in Missouri, the Joplin, Missouri, and there was an insurance company there, Barton Mutual, that was focused on Joplin. It was a really bad tornado, and it ripped through the town, and it ripped through the balance sheet of the insurance company, which went insolvent, but was rehabilitated. And Barton is back in town because of the action of the Guarantee Association. I mentioned the California one; other states have them as well. So companies have that kind of diversification. That's the belt. And in the insurance industry, people say that insurance underwriters and actuaries like to have belts and suspenders, keep their pants from falling down from two possible ways of losing their pants. So belts and suspenders. So the second one is the suspenders at the reinsurance. Insurance companies look at their portfolios. They learn from their losses, certainly from 1992, and they say, what's the most that we could possibly pay out from a storm like this? What's the worst that could possibly happen? What is the maximum possible loss? The MPL. Um, okay, so it's the maximum possible loss could be, say, $5 billion for our book, and we only write, $2 billion of insurance. So we can't afford to take on all this risk. So the reinsurance industry consists of reinsurance companies that are insuring insurance companies. So an insurance company may say, okay, the most that we're prepared to lose to pay out on California homeowners insurance, and this actually is data from a company, from a real company. The most that our retention, how much risk we're going to retain, $150 million. And above that, we're going to buy reinsurance protection from the reinsurance industry, and they're going to cover another $2.5 billion. So the reinsurance company steps in when the retention is breached, and they pay in that layer. And then if it's a really, really bad loss, there is something called a reinstatement. It's like reloading your gun. You put another bullet into the gun, you reload, and it's a capital reload, and the goes back to the insurance company, and they buy another tranche of reinsurance, and they pay about $100 million for that, and they have another $2.5 billion of reinsurance. And what about the reinsurance companies? They have risk as well. Well, there's insurance for reinsurance companies called retrocessional reinsurance. So you've got these three layers of protection. You've got the primary insurance companies. On top of that, you've got the reinsurance. And then on top of that, you've got retrocessional. And in the another thing that started from 1992, you asked, what changes have been made, is the birth of the catastrophe bond market, insurance-linked securities. There's a lot of investors, institutional investors, that think that insurance risk is divorced from capital market risks. What happens on Wall Street with the stock and the bond market is uncorrelated with whether there's an earthquake or a hurricane or not. So it's uncorrelated risk, and they're prepared to lose money maybe once every 10 or 15 years if you have a really bad loss. So you have private capital that's come in as well, and the thriving catastrophe bond market is another player that takes on risk. So you're spreading the risk around, so that even if you have this major event, like the estimate of what's the insured loss, about 28 to 30 billion dollars. If you listen to the earnings calls of the insurance companies, they're sounding pretty sanguine, because when you talk about $30 billion of insured loss, that's including reinsurance, and a lot of this loss is going to be borne by the reinsurance companies, and they've protected themselves with diversification as well, and by only taking a small piece of the risk. So Farmers, for example, Farmers Insurance, which is headquartered in California, has got over 100 reinsurance companies that are participating in its risk. So its reinsurance panel, it's called a panel, the group of people that are involved, has got over 100 companies. So you're really spreading the risk around, and you're spreading it globally, because the reinsurance industry has got a very strong locus in Western Europe, Munich Re, Swiss Re, Hanover Re in Germany, SCOR Re in France. You've got Bermuda reinsurance companies that take California risk. You've got Lloyd's of London with its 75 syndicates, and about a quarter of those take on U.S. California catastrophe risk. And you've got in the U.S. Berkshire Hathaway. Berkshire Hathaway has got this giant, everything that Berkshire Hathaway does is giant, but they have a giant reinsurance company, National Indemnity Company, and you've got reinsurers in China and Japan. So if you look at the list of reinsurers that are protecting individual insurance companies, it's like, wow, that's a lot of companies, and they're all taking a small piece, because again, they don't want to have concentration as well. Reinsurance companies rarely fail. Like big European companies were established in the mid-1800s in Cologne, Germany, and in Munich, and they've been around for close to 200 years. So that's the role of reinsurance, which is very important, and it is one of the main risk management mechanisms that insurance companies use, so that this kind of event, even though it's very large, is only an earnings event. It's going to impact the earnings for the first quarter, and maybe for the year, but not a capital event. Not a capital event.
Yeah, yeah. No, so Jerry, this is fascinating, and just to summarize, you have the homeowner, and then the first line there, you mentioned Geico earlier, and my guess is everybody knows the gecko, and then you mentioned homeowner. You mentioned farmers. Right? That's the one and I think that commercial goes, "We are farmers," dun, 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 right? So everybody will recognize farmers. And the reason they recognize these insurance companies are their business to consumer. And they're spending a lot of money, obviously, on marketing and making sure people know them and they're comfortable with them. And they will take a relatively wider margin. They'll diversify all over, as Jerry mentioned, between lots of different products. And then they'll go to the reinsurers, and reinsurers are actually business to business. We don't know, or my guess is the audience probably would not recognize any of the reinsurers. And then you have catastrophe bonds, which jump up and down in popularity here on Wall Street. And those companies could take thinner margins because they don't need to put out commercials, and that's right. It's really a business to business. So it's fascinating in that the industry's matured to such a point where you have this huge event, and no one's going insolvent. They're able to really spread the risk pretty much globally and amongst lots and lots of participants in the market who understand the risks. So that's fascinating. I think I want to close out by, we mentioned Hurricane Andrew and the insurance industry, and I'm sure government learned a lot from that seminal event. Where do you think government in California, because it really is, as you mentioned, on a state level, there's this assessment that's happening. I think, did you put out $1 billion or 100 million? I forget the number.
A billion, a billion.
A billion. So you have a $1 billion assessment, right? Which hits the insurance companies that play a part in it. By the way, it's the same kind of mechanism that works with stocks. You have the clearing corporation, and there's members of the clearing corporation, and they have the benefit of making money when people trade, and then they sometimes get assessments if things happen. So it's a good kind of mechanism that works within finance. But Jerry, maybe you could talk a little bit, just to close out, on where, especially given your role currently, where does California go on the government side? How do you think insurance providers react to this event going forward in California?
Yeah, the question is, why was this so bad? And it was very bad. And first thing, the most important thing, is the loss of life. 29 folks lost their lives from this fire. Very tragic. It's a human tragedy. Just about everyone I know, many people that you know, have got stories. He's got some connections to Los Angeles. So we don't want this to happen again. And why it was such a big event, and why it spread so rapidly, hour by hour, with those hurricane force winds, is because of, again, problems in California. Normally, historically, and geologically, wildfires happen because there's brush, dead trees, forests that are very dense are very exposed to fires. But for the last 75 years, you probably remember Smokey the Bear. Smokey the Bear, if there's a fire, you got to put it out. If you're burning something, you pour water over it. So there was an attitude that fires have got to be put out immediately, and there wasn't forest management. There hasn't been good forest management in California. What do we mean by forest management? It means clearing the forests of this tinder. It's fuel for the fire. After the Camp Fire of a few years ago, it took over 2 years to get the approval to do some forest management. That includes prescribed burns, because fires are naturally occurring. It happened in places that were uninhabited years ago. Now those places are inhabited. You've got people living in the wildland urban interface. So, but the forests in California aren't being managed. There was a hearing last week at the subcommittee of the House Judiciary Committee, where the expert witnesses all talked about the problem being that the forest management is not up to snuff. It allowed these forests to get really dense, and those drought conditions that were present. It only rained, about an inch in the last 6 months in California. It was just waiting for fire to happen, but because the forests weren't managed well with clearings and prescribed burns, it was hard to get permits for those. That contributed to the severity and to the amazing speed, which really was remarkable. And California also doesn't have the manpower. There's a source that shows the salaries of California civil servants, And the most highly paid civil servant there is a fireman who made $900,000. There's other firefighters in California that are making $500,000 or more. So California has had to resort to prison labor because it can't afford to bring on more people that are making $500,000 a year. It's much almost as a managing partner on Wall Street. Well, not exactly, but that's a lot of money for a civil servant. So California has got this populist history, Proposition 103, and I think it really needs to be looked at and to prevent fires from becoming these horrible conflagrations, having building codes, preventing building in places that are too exposed to harm's way. So that's what the future holds. The word that I keep coming back to is resilient. The industry has been resilient. It's like the old Timex commercial. It took a licking, but it kept on ticking. The insurance industry is built for catastrophe events. That's its raison d'etre. That's why it exists. That's its job. So it's figured out, as you summarized so well, Joe, all these mechanisms to limit the risk and to spread it around so that they can stay there and be in business for the next catastrophe. But in California, you need to have a hard look. Proposition 103. You need to do something about forest management. Those are two areas that can reduce the risk. And if you reduce the risk, you can reduce the rate.
Yeah, Jerry, that's great, and I want to thank you in that you pulled back the focus onto you kind of paused at the devastating loss of life. 29 people lost their lives. Bringing it back to there for a moment. I was in LA in September. I have some dear friends there. I checked on them after the fire. One of them could see the fire out their window. They have a view, I think, of the Hollywood Hills. Hopefully I got it right. We'll see. And ultimately, homes, you bring your kids up there, you live there. It's something that you lose that security when there's a fire so close. It's devastating. So our hearts go out to LA. Insurance, so you pay insurance and you hope it never plays out. Insurance's role is that resilience and that continuity and that capability to move on if you have a devastating event. Because at the same time, houses are really expensive, especially in California, especially in LA. And to be able to start over, as devastating as it is, we have to start over, and that's where it goes. This has been a fantastic conversation. Thank you so much for shedding light on the insurance space, especially in context with LA. It was great to have you on today.
Thank you very much. It's been a pleasure. Thanks, Joe.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedi Smooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.